Measurement, valuation, and disclosure. Assess long-term items. This study unit discusses long-term assets. Topics covered in this study include valuation, classification, and measurement of debt and equity securities. Initial measurement of property, plant, and equipment. Depreciation methods, accounting for intangible assets. Investment in equity securities. An equity security is an ownership interest in an equity, common stock or preferred stock, or a right to acquire or dispose of such an interest, warrants or call options. Convertible debt security are not equity interests in the issuer. This subunit applies to all investments in equity securities except for investments accounted for under the equity method in consolidated subsidiaries for which the entity has elected the fair value option, FVO. The accounting method for an investment in voting stock depends on the presumed influence that the investor has over the investee. The presumed influence usually is determined based on the ownership interest held. The table to the right depicts the three possibilities. Fair value measurement of an investment in equity securities. The following summarize accounting for equity securities measured at fair value. The investment is measured at fair value at each balance sheet date. Unrealized holding gains and losses on the remeasurement of the investment to the fair value are reported in the income statement. Net income at each subsequent reporting date. Realized gain or loss on the sale of the equity security is included in the net income on the income statement. Dividends received from investment in equity securities are reported as dividend income in the income statement. Cash flows from purchases and sales of equity securities are classified in the statement of cash flows based on the nature and purpose for which the securities were acquired. As you can see on the screen, equity security presumed influence, little or none, accounting method, fair value measurement, balance sheet measured at fair value each balance sheet date, income statement, unrealized holding gain or loss on remeasurement, dividend income, and statements of cash flow, purchases and sales classified based on the nature and purpose. Yeah. Impairment test. A qualitative assessment of whether an investment is impaired must be performed at each reporting date. An investment is impaired if the fair value of the investment is lower than its carrying amount. A qualitative assessment may consider many impairment indicators such as significant deterioration in earnings performance, credit rating, or asset quality. If the qualitative assessment indicates potential impairment, the entity must estimate the fair value of the investment and perform a quantitative impairment test. The carrying amount of the investment is compared with its fair value. An impairment loss is recognized in the income statement, net income, for the excess of the carrying amount over the fair value. Impairment loss equal carrying amount subtract fair value. Equity method. Significant influence. An investment in voting stock that enables the investor to exercise significant influence over the investee should be accounted for by the equity method, assuming no fair value option FVO election. Significant influence is presumed to exist when the investor holds between 20% and 50% of the investee's voting interest. Shares of common stocks or preferred stock held by the investor is irrelevant. Preferred stock usually is non-voting. Application of the equity method. An equity method investment is initially recognized at first. Under the equity method, the investor recognizes in income a share of the investee's earning or losses in the period for which they are reported by the investee. An investor recognizes increases in earning and the investment accounts for its share of the investee's net income for the period. An investor recognizes a loss and a decrease in the investment account for its share of the investee net loss for the period. The investor's share of the investee's earnings or losses is recognized only for the portion of the year that the investment was held under the equity method. Dividends from the investee are treated as a return of an investment. They have no effect on the investor's income. The investor's share of dividends distributed by the investees increases cash and decreases the investment. If an investor can no longer be presumed to exercise significant influence, for example, due to a decrease in the level of ownership, it ceases to account for the investment using the equity method. Investments in debt securities. A debt security represents a creditor relationship with the issuers. In addition to the common forms of debt, this category includes mandatorily redeemable preferred stock, stock that must be redeemed by the issuer, preferred stock, redeemable at the investor's option, collateralized mortgage obligations, leases, options, financial futures contracts, and forward contracts are not debt securities. This subunit applies to all investments in debt securities. Debt securities are classified at acquisition into one of three categories. The classification is reassessed at each reporting date. By category, we will have some criteria. For held to maturity, debt securities that the reporting entity has a positive intent and ability to hold to maturity. And trading, debt securities intended to be sold in the near term. Available for sale, debt securities not classified as a held to maturity or trading. Held to maturity securities amortized cost. An investment, a debt security is classified as a held to maturity when the holder has both the positive intent and the ability to hold the security until its maturity date. The investor may intend to hold the security for an indefinite period. The possibility may exist that it will be sold before maturity to supply needed cash, avoid interest rate risks. In these cases, the security cannot be classified as a held to maturity. If a sale before maturity takes place, the security still can be deemed to have been held to maturity if change in the market rate does not have a significant effect on the fair value, or sale is after collection of 85% or more of the principal. Held to maturity securities are reported at amortized cost. This is initial cost net by any unamortized premium or discount. Debt security is trading. It will be stated on the balance sheet as current assets reported at fair value. And on the income statement, interest income includes any amortization of premium or discounts and unrealized holding gains and losses and realized gains and losses. And on statements of cash flows, typically consider operating activities. Available for sale securities, fair value through OCI. Securities that are not classified as a held to maturity or trading are considered available for sale. The initial acquisition is recorded at cost. At each balance sheet date, available for sale securities are remeasured at fair value. Unrealized holding gains and losses resulting from the remeasurement to fair value are reported in other comprehensive income. Tax effects are recorded directly to OCI. Amortization of any discount or premium is reported in available for sale securities or an allowance on and to interest income. Receipt of cash dividends is recorded as dividend income or part of unrealized gains and losses for an available for sale security designated and qualifying as the hashed item in the fair value hash are recognized in earnings. With trading securities, we represented on the balance sheet as current assets are reported at fair value. And on the income statements, it will be interest income, includes any amortization of premium or discount, unrealized holding gains and losses, unrealized gaining and losses are all shown on the income statement. And on the statements of cash flows, trading will be typically considered operating activities. Then you can see that for available for sale securities, there's some difference. On balance sheet, it will be shown as current or non-current assets and reported at fair value. Equity section, unrealized holding gains and losses reported accumulated other income, other comprehensive income. And on income statements, it will be shown as realized gains and losses or interest income, including amortization of premium or discount. And unrealized holding gains and losses will be shown on the statement of comprehensive income. And purchases and sales are investing activities for statements of cash flows. So now we will come to impairment. Unrealized changes in fair value are recognized in earnings, income statement, if they represent permanent declines. The amortized cost basis is used to calculate any impairment. The amortized cost basis differed from fair value, which equals the cost basis plus or minus the net unrealized holding gain and loss. If a decline in fair value of an individual held to maturity or available for sale security below its amortized cost basis is permanent, the amortized cost basis is written down to fair value as a new cost basis. The impairment is a realized loss included in earnings, income statement. The new cost basis is not affected by recoveries in fair value. Subsequent changes in fair value of available for sale securities, except for other than temporary declines, are included in OCI.